if there is no intervention, sure, rates can go out on the long end, no doubt. But do you really believe that we're just going to sit by, or the Fed in particular is going to sit by and and just lose the long end of the curve? I don't see it. I think there are too many negatives for that happening, and so there's many interventionist type policies that they can take on to control that. So, you know, again, if nothing happens, we're very happy to clip coupons where they are. But the change in rates, from our opinion, is definitely skewed lower, not higher.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Today's guest has a contrarian bullish view on bonds, especially when looking out over the next 3 to 5 years. While consensus still leans cautious, his take is that this moment offers a rare setup for strong bond performance. Why? Well, let's ask the man himself. Today we've got the good fortune to welcome to the program Jim Masturzo, CIO of Multi-Asset Strategies at Research Affiliates. Around 150 billion in assets are managed worldwide using investment strategies developed by Research Affiliates, so they have global impact. Jim, thanks so much for joining us today.
Thanks for having me.
Hey, well, it's a real pleasure. It's your first time on the channel, so thank you for joining us. I have had your colleague Chris Brightman on the program before, very sharp guy. Expect nothing less from you, so this should be fun. But since it is your first time, if I can just ask you an intentionally high-level question to kick things off here, just so folks get a sense for how you see the world, what's your current assessment of the economy and financial markets?
Sure, it's a great question, and I feel like this entire year there's been a lot going on. Sometimes you can ask this question and things are a little less volatile, a little less going on, and the answer is it's a little more boring. But you know, with everything that's been going on really daily for the last 9, 10 months, there's a lot to think about. So, you know, if you asked me this question, 6 months ago, what were we seeing? Well, tariffs were starting. We were starting to talk about tariffs. Bond yields were kind of moving around. People were talking about the fact that, bonds are risky, that the debt and deficit cycle had ramped up to an extent, not just in the US, but across developed markets where no one was going to want to hold sovereign debt anymore. And so we're going to have to go to all these sort of, crazy things to manage that. But what did we see? Well, except for a blip in April, U.S. equity markets have continued to, to roll forward and reaching new highs in Q1, and it's really continued, but mainly in Q1, we saw that in developed markets as well and emerging markets. And so, equities were doing well, but now we get to the point where, okay, now we're starting to feel the impacts of tariffs, and there's debates on how much of that is flowing through to inflation, and we can talk more about that. But we're seeing impacts. We're seeing impacts from immigration, reductions in immigration, cracks in the labor force, those sorts of things. And so, I really think we're getting to a point of, I don't want to call fragility is probably a word that's too strong, but definitely starting to, see some cracks. And so getting to that point where I think taking some risk off the table, not going full in. We're seeing it, a little bit in equity markets over the last week or so. We're seeing it in crypto markets. The oil market obviously has been, selling off for quite some time. So I would say, cautious to maybe slightly more than normal cautious.
Okay, so this is a good segue then to bonds. So um, my question I want to ask you is okay, so why do you think the market is currently too bearish on bonds? Um, and it could be because the market is still too focused or has most of its focus on tariffs and what might happen inflation-wise going forward. But one could also make the argument, if we're entering a point of fragility, then the odds of a safety trade start building, and maybe that's the core of your bond thesis. Don't want to put words in your mouth. So why is the market too bearish on bonds right now from your perspective, and why are you more bullish?
Yeah. So, it's funny. I think I think Fed bashing is like a sport that people have.
Mhm. Certainly the president's favorite sport.
Uh, I didn't want to name names, but you went there. So yes, in particular the president, but many others. And I've actually been relatively supportive of the actions of the Fed. I think the wait and see approach has been the right thing to do. So, coming into the year, to address your question directly, and again, we were talking about debt and deficits in particular. So, debt levels have gotten to a point where that are just so extreme that every time interest rates rose 5 basis points, 10 basis points, the headlines would scream, okay, the Fed is losing control of the yield curve. Rates are going to spike. No one's going to want to own bonds.
Mhm.
Definitely not long bonds. Stay out of that. And so, as I've looked at it and said, well, first off, on the short end, why would we cut rates? The economy's been strong. Asset prices are, we're rising. And again, I think this is more of a retrospective of how we got to here now. I think we're actually at this inflection point where now going forward, things should change. But essentially, the 10-year yield hasn't moved since the beginning of the year. Actually, it's down a little bit from the beginning of the year. It's up from its lows in April, but really hasn't moved. And so this idea that, housing is going to crash because, markets are too, again, rates are too high and too much of all of the spending. I agree with that premise that yes, deficits can't continue on the direction they're on, but this is a 3 to 5 to longer term problem, more of a secular, even a, quote unquote, super secular type problem. This is not a problem for 2025, 2026, 2027. Now we get to the fragility that we just talked about. As we start to see this fragility, increase, well, there's a great reason for beginning to lower rates. So if you're a bond investor right now, you own short-term T-bills, you're making, 4.25, 4.5, whatever depending on where you bought them. If things don't move, well, you know what? Enjoy your coupons. And
Mhm.
if they do move down, well, then you're going to get some nice capital gains on top of it, especially as you start to move out the curve. We've been very bullish on the middle of the curve, kind of the belly of the curve, call it somewhere between the 2 and the 10, focused on kind of 5 to 7 year, but even out to 10 years is perfectly fine. Now, you mentioned inflation, tariffs, and what does that mean? Absolutely. Are we starting to see impacts from inflation? I believe so, yes. And that could essentially move increase the long end of the curve. But then you have to ask the question, to how far? If there is no intervention, sure, rates can go out on the long end, no doubt. But do you really believe that we're just going to sit by, or the Fed in particular is going to sit by and and just lose the long end of the curve? I don't see it. I think there are too many negatives for that happening, and so there's many interventionist type policies that they can take on to control that. So, you know, again, if nothing happens, we're very happy to clip coupons where they are. But the change in rates, from our opinion, is definitely skewed lower, not higher.
Okay, let me ask you a question about inflation that I've asked some other guests of late. I'd like to get your opinion. Um, a lot of people's mind, tariffs equals inflationary. Um, but aren't tariffs generally a one-time price shock? In other words, are tariffs really a sustained inflationary impulse, or is it just a repricing that then equilibrates and potentially your inflation rate after that is zero because you've already had the price change?
Yeah, I think by definition, that's absolutely true. I think what we see though, and what will feel a little more consistent because the impacts are not going to be one time pass through all the tariffs. Okay, we move the prices and everything is the same. What we're seeing is kind of in dribs and drabs. So recently we saw the difference between PPI numbers being up a lot, CPI up a little bit. So the story being that some corporations are eating the tariffs. Well, they're not going to eat the tariffs forever. They'll eventually pass through more and more of that. So I think we're going to see incremental increases in inflation, not this one time, okay, everything went up, but hey, tariffs are good now, everything's going to be flat. And that consistent rise, although it'll be the same magnitude as if it happened at once, will feel worse, I think. And so I think there's a little bit of a just behavioral impact that will drive certain investor behaviors.
Okay. So don't let me be too simplistic here, but on the argument for higher bond yields
Mhm.
going forward is um, uh, inflation, that maybe tariffs are more inflationary than is currently priced in, and therefore bond investors demand more from that. Um, there is maybe continued deficit spending, right? Where if the deficit stays where it is or gets even worse, then bond investors say, okay, I got to get compensated for that as well. So that's sort of on the side for higher rates. Now, you said you think the bias or the probabilities are more to the downside, right, with rates or yields. And obviously, Fed cutting will have some impact, um, obviously much more on the short end of the curve, right? Um, Presumably, your points of fragility, um, easy to interpret that as sort of an economic slowdown or whatnot, right? Less demand, and potentially if there's concerns about market integrity or economic integrity, well, then the safety trade starts to kick in. That brings yields down as well. Why does in your mind, did I leave out anything else that's important on either side? And why do you think the odds of lower yields outweigh the odds of higher yields right now?
Mhm. So maybe I'll add one thing on both sides before we're getting to the question. So on the upward pressure, and we talked about inflation from tariffs, there is some risk of wage inflation. Wage inflation, particularly coming from reductions in immigration, reductions in labor. Now,
Okay, because the
fragility,
remaining U.S. labor basically can demand higher wages.
that's exactly right. Now, the fragility that we're talking about, which is economic fragility, I think will offset some of that. But all else being equal, reductions in the supply of labor should push up, or give existing labor more power to ask for higher wages. But so that's on the one side. The other side, when we think about reductions or let's just say let's just call it reductions in bond yields, is really around valuations. And so if we start to look at valuations in other asset classes, well, you know, the PE ratio of US stocks, and we
Hmm.
tend to look at the CAPE ratio or the cyclically adjusted PE ratio. We're getting back into those upper 30 levels. So let's call it, 2.8, 2 point something, somewhere 2.5 to 3%, earnings yield on US equities relative to, 4.5 on bonds. Um, so there's a trade-off there between equities and bonds. Now, obviously US equities are not the only game in town, although if you ask many investors, they have been over the last, 15 years where it didn't make sense to go elsewhere. It does now. Um, Lowering rates on the short end, you talked about, Fed reduction in rates will lower rates on the short end, obviously. The other thing that does is bring back foreign investors into US bonds, particularly because the hedging cost of the currency becomes much cheaper. It's very expensive to hedge, for foreign investors to hedge US currencies right now because the US short rate is so high relative
Hmm.
to their local rates. So there's an increase in the investor pool as rates come down on the short end, even to, call it 10-year treasuries. And again, that trade-off, I think, is really important, that at some point, the Magnificent Seven, it's hard to believe now that they're going to be able to achieve what is priced into, their current multiples.
Hmm.
Something like someone was telling me the other day, and I'm going to take them at their word, that Palantir has to grow 40% a year for the next 5 years to be able to sort of justify their, current multiples. I haven't checked that one because as value investors, we try to, avoid the things that are expensive anyways and don't spend a lot of time thinking about them. But this, it becomes very hard to want to continue to buy US equities where they are today.
Okay. So part of this is just sort of a sector rotation where equities have just become so expensive that upside potential seems limited. The dividend yield is real low relative to what you can get paid today on safe bonds, right? And so part of it just could be just simply that, right? And interesting point you say about foreigners becoming increasingly interested in owning U.S. debt as the yields start to go down. There's been a lot of talk of recent years of how foreign governments have reduced their purchases of U.S. sovereign debt,
Mhm.
which is true. And we've
Mhm.
seen them, on a relative basis, increase purchases of things like gold as a potential alternative. And some people have taken that as the world is abandoning U.S. treasuries, and treasuries are
Mhm.
poised to end up in the dustbin of history. I think you're saying that's probably not the case. And to be honest, there probably will be, a rotation back into treasuries by foreigners as those hedging costs go down as yields come down.
Yeah, that's absolutely right. I mean, for anyone who makes that case of, and I've heard it many times as well as you have on treasuries are dead. Just look at global trade. How much trade is done in dollars? Foreign governments need dollars. They need dollars to protect their own currencies, and they need dollars for trade. And those dollars are going to get reinvested into something. Some of that reduction in US debt also went into US equities. And so those governments were, appreciating the returns of, the US stock market, which again, as they start to think about some of these, offsets of, fragility in the equity markets can come back into bonds. So I don't put a lot of credence into, again, the idea that US treasuries are dead over the next, handful of years. And really, we start getting into that conversation of, yes, the U.S. debt situation is dirty, but are we the cleanest dirty shirts? You can make arguments that yes, even though I, for one, hope that we address these situations, before we get to that obvious tipping point. Although I tend to put no faith in politicians, so we'll
Yeah.
see what happens.
But to your point, it does beg the question, okay, so the world starts getting into trouble again. I mean, you talk about points of fragility here in the US economy. If the US starts stumbling, odds are a lot of other countries are stumbling even worse than we. So the question is there has another asset taken over the number one slot as the global safe haven, uh, you know, harbor of safety in trouble? And I don't know. I mean, as favorable as I am about gold, it's just not a big enough market to absorb all that. I mean, it still seems when spooked, people are going to turn to treasuries.
Yeah, I feel the same way. And I'm a big proponent of gold. I think owning gold is a great idea for most people. So, but you're right, the market isn't large enough. I don't know what your feelings are on the crypto markets, but they're not evolved enough to, to take the place of sort of a
Yeah. I
safe
mean,
haven
right now,
asset.
crypto seems to be acting much more as a risk on and not a risk off asset. So yeah,
Yes, exactly. And even if you subscribe to the theory that we'll get there, seems to be a long ways away. I don't see in, next year or the year after we're talking about, Bitcoin being a safe haven asset or anything even close to that. So, or any of the others. So,
right. So
yeah, so then you're
whose
back to,
sovereign debt are you going to pick over the treasury in time
yeah,
of trouble? I mean, it's hard to point at anyone and say, oh, that's demonstrably better.
I think I think a really interesting chart that I tend to look at is the Swiss franc, which is, the Swiss franc has hit its, you know, I guess, low or high, depending on how you're thinking about the currency pair, but let's just say it's strongest in the last 20 years. Well, that's just not sustainable for an economy of that size to have a
Hmm.
currency that is that strong for so long. They're back into negative rates. So, you know, to your point, it's just in my mind impossibly hard to find any particular government debt market that is safer, deeper, large enough, all those sorts of things as the US market. So, this idea that governments are just going to stop wanting to hold treasuries, I just think is somewhat foolish.
Okay. All right. So a couple of things. Let me try to bang through them if I in logical order here. So again, I don't hear you saying, "Hey, the U.S. is going into recession." I just hear you saying, "Hey, there's points of fragility." And as I said earlier, I sort of interpret that as okay. We're seeing data that the economy is slowing. Um, the labor market is starting not to look as healthy as it has, and that's using the official data. And I think we've gotten to the point in the story where kind of nobody believes the official data anymore, meaning it's probably worse, right, than what we're working with right now. Um, so you know, not even bringing up the word recession, just slowing economy, that is disinflationary. Right. So to a certain extent, that should assuage some of the inflation fears if you expect that at least in the near term, the economy is gonna slow here. And let's say next quarter or two. I'm not projecting much more than that. Um, Secondly, you said that if I heard you right, that there's a lot that the central planners, but the Fed can do here that it hasn't done. And I'm not saying it's going to do this, but to your point, long end of the curve starts getting away from it. I mean, it could go back to QE, right? It could start buying long dated treasuries and start trying to pull that part of the curve down, right?
Mhm.
Um, Third, you've got an administration that is very publicly committed for very obvious reasons to saying, look, we want a lower treasury yield.
Mhm.
We had our debt service cost spike as yields went up during the Fed's hiking regime. But now we got to get that down because it's eating a too big of a chunk of our budget. And Trump and Secretary of the Treasury Bessent have been very, very clear that that's their agenda. Now, you said earlier that it hasn't really moved all that much. And so the skeptics could say, well, maybe they're just not going to be very successful at it. But there probably is, there's a lot that they can continue to do policy wise to try to wrestle that rate down. So those are kind of three big things. I'll take a beat here for a second, but are those three of the big things in your argument for why you think the propensity is probably more for lower rates going forward?
Yeah, I mean, you nailed it, and you probably summarized it better than I could have.
I
But
doubt it.
it really is those. You've got these major forces that have said we don't want higher rates, and you mentioned QE, and some people remember Operation Twist. We've got explicit yield curve controls that they could do, and we've done it here in the past. I've read many stories that say, well, we won't do yield curve controls here in the U.S. We did them after World War II. Japan's done them more recently. You know, when you start to get to that point, and I will say that if we start getting into explicit controls over the longer end of the curve, we're probably getting close to crossing the Rubicon. Um, but there's nothing that makes me believe that we have to do that in the short term. The market has been willing to step in and keep rates where they are. But as you say, there's a lot of we used to call it the economic bazooka that
Mhm.
the central banks had, and they were willing to fire. So there's a lot of bullets in that bazooka.
Okay. Um, all right. So, and again, we don't know what the administration, its full bag of tricks is going to be at this point in time, but we get a pretty good sense of what its main policy priorities are. So let me ask you this. First off, I mentioned the recession word earlier. I haven't heard you say it yet. Um, how much of a concern is any right now through the lens you look through at research affiliates? Is this something that you're you're warning clients about, or is it just more a slower economy, but not a contracting one?
We're more in the slowing camp than the recession camp at this point. But as we talk to our clients, as we always, we have for quite some time, it's really around diversification. So yes, you own U.S. stocks, and a slowdown will, impact U.S. stocks. We're telling you all the reasons to buy U.S. bonds. Well, let's not even worry about the recession, because let's talk about outside of the US and what the opportunities are. So in particular, as mentioned earlier, emerging markets, it was actually very interesting that finally in the early part of this year, investors seem to remember that, hey, there's a lot of activity going on in emerging markets. Their um, fiscal setup looks much better than developed markets, and also better than emerging markets in the past. And also their valuations are, look quite attractive. And we haven't talked about, the dollar and the impact of the dollar. Obviously, the strengthening dollar for the last, 12 years, or really through kind of through 2022, when we really hit the strengthening of the dollar, which used to be a headwind for U.S. investors investing outside the U.S. Well, hey, that's the weakening dollar is actually a tailwind now. So as we talk to our clients and as we think about these things, making a recession call is very, very difficult. That's why it's usually done, a year later.
In arrears, yeah.
So, but if you're thinking about how to diversify your portfolio, how you're looking for, all the value opportunities that are out there, then, you can play offense instead of worrying about, playing defense on, is it a recession? Isn't it a recession? What's the cool off going to mean, for asset prices, that sort of thing.
Okay. So I want to ask you in a second, where in emerging markets are you seeing the most opportunity right now? And presumably when you're talking emerging markets, you're talking mostly emerging markets equity, I'm guessing. My guess is you're thinking that US bonds probably better outlook than emerging market bonds as yields start to come down in the US. Is that correct?
We like emerging market debt as well, in particular
Okay.
local currency debt. We're not bullish at all on hard currency debt or emerging market debt that's denominated in dollars.
Okay.
We like emerging market local debt, but the U.S. Treasury market is just so much larger and liquid, and for most investors, I think much more comfortable.
Yep.
Um, you know, so
Okay.
yes, I mean, usually we're talking about equities, or at least focusing on equities.
Okay. All right. But before I ask you to get specific there, let me just ask you this. So we do have a bunch of policies that have been aggressively enacted early by this new administration that presumably will lead to increased economic growth at some point, right? Whether this is the additional tax relief from making the Trump 2016 tax cuts permanent, whether it's the deregulation that they're going on, um, whether it's the reshoring of American manufacturing, whether it's these trade deals that are getting struck that presumably are ending up with better deal terms from America than we had before. We've got lots of commitments from countries and large multinational companies to put basically trillions, to work inside the U.S. that weren't pledged before. Right. So who knows if all these, will be enacted as envisioned, but it certainly seems that the administration is continuing to, get the legislation passed that it wanted to get passed and is getting more and more of these types of deals. So presumably, and probably hopefully, some fair amount of them actually, go into an action the way that they're hoped to. Is that a cavalry that you do think will ride to the rescue here in terms of the economy kind of slowing in the near term? And if so, how material will it be?
Well, as you say, I think we all hope that these things will materialize in the way that they're being described, but I think it's such an unknown. We don't have a lot of information on many of the trade deals. The promises of investment, we're not really sure what that means or what the timing looks like. the onshoring and manufacturing, I think, is great, but not going to probably do a lot for the labor market, considering much of that will be automated and so forth, but still good for asset prices. So I think we also need to think about the differences between, the economic benefits and the, benefits to the asset markets. So from an investor perspective, and for the purpose of this conversation, we're focused on the latter, and that's
Hmm.
great. But it's just unknown, right? It's these things that seem to be moving targets, and depending on which side you ask, you get very different answers. When we talk about, the trade deals with, pick your country, and when they talk about them, at least from the stories I read, it's, it always seems to be a little bit different. So, I mean, I think, in the longer term, and by the longer term, look, maybe we're talking about, 18 months from now, these things really did start to take effect. Some of the deregulation takes effect and helps growth. And so, on a maybe optimistic perspective, end of 2026, we could be very optimistic that these things are happening. But I think where I sit right now in 2025, I'm not banking on them. I think it's worth, um, again, looking at other opportunities, because I think there are a lot of opportunities out there, particularly from a valuation perspective, um, relative to, waiting and seeing what's going to happen with, some of these announcements, and do they actually, mean shovels and things like that.
Okay. So again, just to make sure I'm sort of understanding your position, um, economy, let's say next 6 to 12 months, maybe more sluggish, bumpier than we would like. US equity markets, very richly priced, meaning probably somewhat vulnerable to what's going to happen economically over the next 6 to 12 months, meaning we could have some corrections in there as earnings estimates get forced to come down. Um, U.S. debt obviously looks attractive in that type of environment. And uh, you know, hey, there's option value there that things could start getting materially better coming into the latter half of 2026 into 2027 from all these policies, but too early to tell. And let's have you back on middle of next year to call an audible as to where things are. Does that sound fair?
That's exactly fair.
Okay, exactly fair. Okay. Uh, Now, that being said, even though you think valuations, painting with a broad brush here, are uncomfortably high in US equities, you sounds like you've said, hey, there's lots of other places in the world where there's some really attractive valuations. So specifically in the emerging market space, what's kind of got your focus there at Research Affiliates?
Yeah, so in talking about, if you had me on next year, what we talk about, if we had this conversation a year ago, and I wrote about this a year ago, Eastern Europe looked very, very attractive. Poland in particular,
Hmm.
that being the largest and easiest to access for most investors, but Czech Republic, Hungary, valuations were, extremely cheap relative to fundamentals. And so, since then, and I think it's, let's see, over the last year, I want to say, Poland's up about 50%, similar to, for the other countries. So now we're seeing valuations that went in those particular markets that went from, very, very cheap to kind of fair value. So still not expensive. So there are still some opportunities there. Um, Country that I actually think is really interesting and is getting nothing but negative headlines is Brazil.
Hmm.
Um, in particular, the tariff on Brazil. I think the last tariff, because it seems, tariffs change a lot, but 50% on Brazil, even though we have a trade surplus with them. But Brazil, is when I talk about playing offense, is out. They've signed a trade deal with China, redirecting a lot of their trade to China, and so we've seen the real rally over the last month, really, since we started talking about the tariff there. So, Brazil, I'm just going to check the number here. Let's see. Brazil is trading at a PE level of just under 9. So again, the
Okay.
US is trading at about 37, I believe, and
My
Brazil's trading at
goodness.
9, which is no reason. And I always have to caveat this because I always get this pushback that, so you're saying that the US and Brazil should trade at the same multiple. No, we're not saying that at all. there's there's a risk premium built into emerging markets. They should definitely trade at lower multiples. In fact, our fair value is somewhere around, call it, 11 or 12. So um, but going from 9 to 12 is a nice benefit, uh, in particular for Brazil. Turkey, another country, trading at 7.5 relative to our fair value, which is about 9.5. So but it's important for, many investors who say, look, I don't want to buy, Brazil or Turkey. It's just too much risk for me, because obviously investing in any particular country is risky. So, the basket of EM, whether you want the entire basket of emerging markets, or you want to split it up by region and go with Latin America relative to Eastern Europe, relative to Asia Pac, all options, and all, again, trading at cheap to fair value relative to, again, relative to the US, that's trading again in the upper 30s, and the all-time high was 44 on the Cape scale back in the tech bubble. And when we think about, again, not to continue to harp on the US, but uh, the natural question I always get is, well, what is the fair value of US equities? What is the fair
Hmm.
multiple? And my answer to that is, well, A, nobody knows exactly, but if we think about CAPE ratios and we go back to 1995, which was, you can talk about the technology boom, the internet age, that's when it started. If you look at the average CAPE ratio in the US from 1995 to today, it's about 28. So, and people ask me, what's my fair value for the US? I say it's about 28 on the CAPE scale. So we're trading at 37.
And usually, reversions to the mean rarely stop at the mean.
Right.
In other words, right, if when momentum starts swinging, it tends to sort of overshoot for a while too, right? So, you may want to ride it even a little bit further, even if it gets back to that 28.
Yeah, and as value investors, we love that, because you can start, when you hit that fair value, you can start incrementally buying in, and yes, things might get a little bit cheaper, but then by the time you hit the bottom, you have a nice position for that rally. So that overshooting is, something that we're, constantly talking about, and look at as an opportunity.
Okay. All right. And so in terms of playing these emerging market opportunities, um, I know research affiliates, I mean, your research is used by kind of everybody on Wall Street and a lot of the big institutions. And a lot of those companies, have staffs of analysts and the ability to really, laser pinpoint specific securities on local exchanges and things like that. For the average retail investor, do you have any sort of general counsel as the better way to play these? Is it a country ETF? Is it a region ETF? Is it actually buying some of these stocks on the local exchanges if your online brokerage lets you do that? Do you have any general advice?
I mean, we tend to tell investors, particularly retail investors, to stick to the ETFs. And for those that aren't spending, a lot of time diving into some of the numbers, such that, to your point on, when things get cheap, they tend to get cheaper than, and go past the mean. That
Hmm.
can happen. So if you don't have the stomach to hold a particular country ETF, which, some of these emerging market countries have volatilities of, in the 20s, which is significant. So if you don't have the stomach for that sort of a thing, then move to a region or two, again, the entire emerging markets basket. Now you're lowering the volatility into the high teens. And so that's a little bit easier to hold through the down times for the average investor. So, if you get all the way down into the individual companies, we usually say for retail, don't do that. Leave that to the folks who do it all the time. If you don't want a passive ETF, there's many, active or quant active strategies. We offer a number of them where we'll do all of that. We're processing all the data to look at all the fundamentals and all the things that are happening with these companies, and then building the portfolio off of that. So, if you're interested in that sort of a strategy, our partners, offer those based on our strategies. for those that don't know, at Research Affiliates, we design strategies and then we partner with other asset managers who actually launch funds based on those strategies. And you can
Hmm.
find those at our website.
Yeah, so the easy way to think about it is you guys are kind of providing the intelligence, and then the partners are actually putting it into execution.
That's right. That it allows us to, have a relatively small firm. We don't need an army of back office folks and accountants and sales folks going out trying to sell these things. We use our partners for those things, and then we focus on designing the strategies and the portfolio construction and the things that we think that we're good at, and the things honestly that we enjoy doing.
Okay. All right. So, okay. So, and as we wrap up here in a few minutes, Jim, I'll let you direct people who want to learn more about your strategies, whether it's to your specific websites or some of your partners or whatever. But just getting back to treasuries for a moment. So obviously you think that duration will be your friend here over the foreseeable future in bonds as the forces you talk about start bringing yields down. Um, Let me ask you this. So there is a lot of capital over the past couple of years, and a fair amount from the folks watching this channel, I know from talking to them, that has made its way into the T-bill and chill trade. Um, I guess first question for you is do you have a projection in terms of how much you think the Fed will bring its policy rate down? Are we gonna, some people, not too many these days, but some are like, oh my gosh, we're gonna go back to the old ZIRP days. I don't get that vibe from you, but don't let me put words in your mouth.
I think through the end of the year, and I know this is somewhat the consensus view of, call it 25 to 50 basis points. I guess
Hmm.
of those two, I'm more leaning towards 50.
Hmm.
I think that's where we'll get by the end of the year. And then it really depends on how bad does the economy get.
How slow things get, yeah.
Yeah. And we'll see what happens next year. Um, Now, once we get a new Fed chair, who knows? That might be where we start to see, larger moves. But at this point, even in, let's call it your normal run of the mill recession. Let's just say that happens. We're not talking about a financial crisis, but just your normal run of the mill
Hmm.
recession. I could see us getting down to 1.5 or 2%. I,
Okay.
I think they learned and they're trying very hard to avoid going back sub 1% down towards zero. Um, doesn't mean it won't happen. Doesn't mean that the forces might, require that. But I think that's a very low probability, given what we're expecting to happen over the next, year or so in the economy.
Okay. So let's just assume for a moment throughout 2026 we're on that trajectory where the Fed is meeting and at least ticking off a quarter point every time, right? So so that the T-bill and chill trade goes away,
Mhm.
right? Where do you think that capital is likely to go, or do you have an opinion on where you think it should go? As people who have been enjoying a nice, safe 4+% on the short end of the curve have to start putting that somewhere else. Is it just going out in duration on the same instrument, or is it going into other types of asset classes?
Where I think it will go is moving out in duration. I think, the T-bill folks will move out to the 2 year and the 5 year, and they'll start to take on more duration within, within reason. And I don't think there's anything wrong with that. I think that's perfectly fine based on all the things we've talked about. Um, where I think there's actually bigger risk is really, we haven't talked a lot about, private markets or private credit, which is
Yeah.
sort of moved its way into the retail market. I would say, unfortunately, I'm not a big supporter of. Not that there's anything wrong with private credit for institutional investors and those that understand what they're getting and have the liquidity, availability to make those investments. But as we start seeing, or if we start seeing fragility in private markets from retail, well, the liquidity premium starts to hurt in the wrong way. We start seeing forced selling. So, um, it's I bring that up because I think the nexus of your question is essentially, will people reach for yield? Which is usually what happens. They're not getting it on T-bills. So, okay, now where can I get that yield? I'm going to start,
Right.
stretching for it a little bit. Um, yeah, I think maybe to answer your question of where it should go, I think taking on some duration is perfectly fine. You're getting this, especially again for retail investors, because you're getting a similar, um, risk profile that you're getting with T-bills. Obviously, you're taking on more duration risk, but it's the same issuer. You're not worrying about those sorts of things. Highly
Yeah.
liquid markets, deep markets, all those sorts of things that if you're not doing this every day for a living, it's not a bad place to stay.
Okay. So, is it, would your general counsel, not specific financial advice, obviously, because you don't
Right.
know any of the people watching independently, or individually, um, but should people who are currently sort of heavily invested in the T-bill and chill trade, should they start taking some of that now out further on the curve? Like if you're sitting here and say, 1 month, 3 months, 6 month T-bills, maybe start moving some of that to a 2-year T-bill. Just because if you know you like 4%, why not lock in that for at least a percentage of your portfolio for the next couple of years? And no matter what happens with the rates, whether they go down or stay where they are, you're still getting what determine you kind of need or really value.
Yeah, and again, not offering any particular advice to anyone, but as I think about it, if someone offered me, a 3-month T-bill or, a 3 to 5 year, treasury bond, I'm probably buying the 3 to 5 year bond because I'm not as worried, and I'm not that worried about the duration risk as we talked about, and I'd rather lock that
Right.
in.
Well,
So
and if you are worried about the duration risk, I mean, unless you need the money personally, if you're not getting paid back on your treasury bill in 3 years because the US government is default, like we've got way bigger problems.
yes, exactly. If I I have that conversation with some folks in my family who are convinced that the US is going to default on its debt. And I say, when that happens, we're talking about wars and other sorts of things. That's not something that's taken on lightly. Maybe I'll just throw in, real quick as, for folks who are thinking, yeah, okay, I'm ready to take on some duration risk, but are worried about inflation. The tips markets are a great opportunity as
Should
well.
have asked about
So
that. Yeah.
you should definitely consider those, particularly again if you're worried about short-term inflation.
Okay. All right. Yeah. I'm glad you brought that up. Okay. And then you mentioned private equity, private credit, and that's a whole, I mean, we could do a whole interview just on that, Jim. Let me ask you this. Um, I have a hard time looking at the move to bring private equity to the retail market, which there's a big, I'm sure you probably know this more than I, right? But I have a hard time looking at that not as just a godsend to the private equity industry to just dump all of its illiquid, underperforming junk that it doesn't want to have on its books onto an unsuspecting retail, public. Uh, am I wrong to think that way?
I don't know if you're wrong, but I completely agree with you. I think the stuff that makes it just historically, we've seen this in many different markets that once they eventually make it to retail, what makes it to retail is the underperforming junk.
Right.
And so I just it bothers me when this happens. But I won't get into that. But yes, I'm not a fan of selling these types of products to retail investors who, just they're not doing this every day. They have day jobs and they're worried about other things and they're not
Right.
understanding or paying attention to the risks.
Yeah, and I just can't see the private equity guys resisting the obvious incentive to just say, all right, look, we're going to let you sell whatever you want to sell to the public markets. Well, you're going to keep the things that are in your portfolio that you're the most excited about, and you're going
Mhm.
to happily dump the stuff that up until yesterday you weren't sure you were ever going to be able to get out from under, right?
Yeah, I think that's exactly right. So I think you and I think about this problem exactly the same way.
Okay. All right. Well, that's a big compliment to me, so thank you. All right. Well, look, this has been a great conversation, Jim. I've really enjoyed meeting you. I talked about having you on, a year from now to give us an audible, but if you would like to come on a lot sooner and, call some additional balls and strikes as they start coming in, would love to have you be able to do that. So for folks that have enjoyed this conversation, maybe this is the first time that they've, heard you talk. If they want to follow you, your work, or more about what's going on at Research Affiliates, where should they go?
So if you go to our website, researchaffiliates.com, you can learn all about the firm. We do a lot of writing about what's happening in markets, particularly, quant markets and things that we're looking at. So a lot of great information there. We also, on our website, have a link to what we call our Asset Allocation Interactive, where we actually publish our long-term expected returns for 150 different assets. So
Mm.
everything from, gold and name your commodity to individual, equity markets, all the emerging markets that we talked about before, as well as developed markets. And so that it's free to use. We just ask that you give us your email address and sign up with a password, and that just allows us to know that you're a real person and not a bot that's trying to troll our website. So all that stuff is free to use again and provided there. So hopefully provides investors with a way to think about where are valuations for various asset classes. So again, that's our asset allocation interactive from our research affiliates website. And you can also, maybe most importantly, as I mentioned, we license our strategies to other firms who actually launch the fund. So sometimes you'll invest in a fund and not even know it's our strategy. Well, we have links on our website to all of our strategies and what they do and the various partners who offer those strategies.
All right, great. So if I'm working with a firm, I can see if they're on your partner list.
Yeah, absolutely.
Okay, great. All right. Well, Jim, when I edit this, I will put up the URL to Research Affiliates there on the screen so folks know exactly where to go. Folks, that link will be in the description below this video as well. You made me think of one asset question I didn't ask you that I'll try to squeeze in right now, which is just in general, your thoughts on commodities. One could make the argument that if the economy is starting to slow, that's going to have less demand for commodities. On the flip side, uh, you're talking about equity valuations, general equities. The ratio of the S&P to the general commodities index, I think, still remains at pretty much near an all-time high. And there's a lot of people that have been saying, we're going to see some sort of reversion to the mean in that. Obviously, the world has become a more competitive place for commodities
Mhm.
as countries are deciding to start to, reshore their supply chains and stuff like that. So I'm curious, what is your general outlook on commodities, over the next couple of years, concurrent with what you're seeing with the your outlook for the bonds?
So, great question. I'll answer it in two ways. I think, let me separate gold from commodities.
Yeah.
I think for investors who want to have a gold allocation, there's a lot of ETFs out there that you can go buy that invest in gold, and in particular, a lot of them own physical gold. So that's perfectly fine. When we think about broad baskets of commodities and broad indices, I am not a big fan of most of the passive commodity products that are out there. Those that track the Bloomberg Commodity Index or the S&P GSCI. Um, if you look over the last, 25 years, they haven't even kept up with inflation. So they tend to not do very well. Where I'm very bullish on commodities and where I think commodities add a huge opportunity for portfolios is really in the active space. So most of these commodities, as we talked about, you're buying commodity futures. So if you're
Mhm.
buying derivatives, the ability to go long and the ability to go short, is basically the same. It's no more expensive to take a direction on a derivative like that. There's also the opportunity to take leverage, and so leverage and shorting are things that professional investment managers know how to do. And so for somebody who's looking for a commodity investment, I would look at active funds, look at some of their exposures. There's a lot of quantitative factor exposures that are out there that make a lot of sense in commodity investing. And so maybe just short way to sum it up is I believe everyone should have an allocation to commodities in their portfolio. I think I think there's a lot of benefits to that, but I would lean more towards active over passive.
And active management. Okay, great. All right. And you probably don't know this, Jim, but I have these financial advisors who appear on this channel every week, and a lot of these guys actually do have actively managed portfolios in commodities. So, folks, if you want to talk to a manager about it, feel free to have one of the free conversations with one of the firms that come on this channel. All right, Jim. Well, look, it has been fantastic. Thank you. Folks, if you've enjoyed having Jim on as much as I have, please let him know that by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. Definitely go check out Research Affiliates and avail yourself of all the resources that are there that Jim mentioned. As I said, if you want to talk to an advisor about, uh, if you're not already working with an advisor that's a partner of theirs, if you want to get some free counsel from a financial advisor about how you might be able to put some of these things into practice in your own portfolio, feel free to talk to one of the financial advisors that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. To set up one of those free consultations, just fill out the very short form at thoughtfulmoney.com. Again, those discussions totally free. There's no commitment to work with those firms. It's just a free service they offer to be as helpful as possible to folks. All right, Jim. Well, look, thank you. This has been great. As we wrap this up, the vast majority of people, we do have actually a number of professional investors who watch these videos, but the vast majority are just regular people that are, here online to self-educate, make themselves more informed investors. Hopefully, I think in most cases, what they don't want to do is lose their money by making poor decisions or get caught by surprise, maybe by a slowing economy. And then above and beyond that, if possible, they want to prudently grow their wealth from here. So given everything we've talked about, do you have any sort of parting bits of counsel for that cohort?
I would just say that, I'm always excited to hear about the people who say, look, I just want to learn a little bit more. You don't have to be an expert to prudently manage your money and to understand the risk return trade-off. And if you are working with someone else who's helping you to be able to understand, all the things they're talking about and how they're thinking about the world. So I'm always excited to, do shows like this where we can talk to real people who are just, hey, it's a problem. I have money. I need to manage it, and I just want to know how to do it. So maybe, forgetting investment advice, where I think we've talked a lot about that over the last hour, I would just say, keep at it. The tools today are so much easier than they were, 5 years ago. You can use your favorite AI tool to ask these questions and start to understand some of these concepts that, maybe you don't understand. So, hats off to you as well for providing this service for people.
Well, thanks. Well, hats off to you for coming on. And like I said, Jim, it's been a really good discussion, and the door is open here anytime you see something on the horizon that starts shifting, the outlook that you share with us here. We'd love to have you come back on and give us an update.
Sounds great.
All right. Thanks so much, Jim. And everybody else, thanks so much for watching.
Rally in the price of gold has, it's more than doubled, actually tripled in the last couple of years. So the thing with gold, just in U.S. dollars, going from say $1,500 per ounce to $3,500 per ounce, which was the recent all-time high. What really happened is the dollar has gone down significantly relative to gold. It's a weakening of the dollar. Now, the dollar has performed much better against other currencies. Recently, very recently, last 4 or 5 months, the dollar has gone down, the major indices, but that was from a fairly high level. It actually got quite strong against all the other major currencies. So I expect the dollar to get weaker against other major currencies. But if you're talking about gold, I would expect the opposite, that the price of gold would go up, which means that all the other currencies are falling even faster. So I would expect the Aussie dollar to get stronger relative to the US dollar. I do expect it to go higher. There's no way that gold is going to double or triple, and silver won't be along for the ride. So you can see $100 silver at some point and even higher from there.
Gold has jumped from $1,500 to $3,500 an ounce in just a few years, not because gold changed, but because the US dollar lost value against it. Though the dollar recently strengthened against other currencies, it's expected to weaken further, with all major currencies losing purchasing power even faster. JP Morgan notes that central banks are accelerating de-dollarization, cutting dollar reserves and boosting gold holdings, with the dollar's share of global FX reserves now below 60%, its lowest in 20 years. Meanwhile, silver is likely to follow gold's rise, potentially hitting $100 or more per ounce. Jim Rickards, an American lawyer, economist, and investment banker turned financial commentator, mentions the U.S. is deliberately pursuing a weaker dollar under what's being called a Mar-a-Lago Accord, tying tariffs, trade policy, and even military protection to currency values. Morgan and Reuters highlight expectations of a weaker U.S. dollar ahead. Asset management models suggest the dollar is overvalued by 10 to 20% against currencies like the euro and yen. At the same time, a softer dollar through 2025 is seen supporting emerging markets, attracting investors toward higher-yielding assets outside the U.S. However, Jim Rickards predicts the U.S. will devalue the dollar, but partners must not devalue their currencies in response. As a result, currencies like the Aussie dollar, sterling, and Swiss franc are expected to strengthen because the U.S. is actively forcing it. To ensure you don't miss any updates, don't forget to hit the bell symbol and subscribe as soon as the video starts. If you like the content, please let us know by leaving a comment below.
I would expect the Aussie dollar to get stronger relative to the U.S. dollar, but there's a very specific reason for that. There's a lot of buzz around the world of the BRICS are coming up with an alternative currency, and people are getting out of U.S. treasuries and losing confidence in the U.S. dollar. U.S. budget deficits are out of control. The U.S. debt is out of control, et cetera. And none of that is basically true. These are talking points, but they have to be put in a context. The U.S. debt, $37 trillion, that's a big number, for sure. But you can't think about debt without comparing it to the resources. What is the GDP behind the debt? What are the assets on the other side of the balance sheet? And those kinds of things that the Trump administration is talking about. And so one of the most influential advisors in the White House right now is Stephen Moran. He's an economist, but he wrote a paper last November on basically reconfiguring the entire global trading system. Pretty big claim. In there, he calls for something called the Mar-a-Lago Accord. And by the way, that was the title of Chapter 6 of my book, Aftermath, which came out in 2019, last time I was in Australia. So I'll take credit for coming up with the name. But his version of the Mar-a-Lago Accord looks at tariffs, trade, and exchange rate values, and kind of getting to your question, Jordan, about the Aussie dollar. Now, let's say I put 20% tariff on it. I'm the United States, and I put a 20% tariff on a trading partner. So some goods are, let's just say 100, it could be 100 million or whatever, but 100 as a measure, and I throw a 20% tariff on it. Now it's 120. But what if the trading partner devalues its currency by 15%? So it was at par, let's say hypothetically, and you drop it from 100 to 100 down to 85 to 100. Well, that negates the impact of the tariff, because yes, the tariff marks up the price, but if you're the producer and you can lower your local currency costs, your labor costs and so forth by devaluing your currency, you dilute the impact of the tariff. So what he is saying, and indirectly what the White House is saying to U.S. trading partners, is we're going to put these tariffs on, so that's a given, but don't you dare devalue your currency.
Sure.
We're going to devalue the dollar. And any trading partner that tries to offset the tariffs by devaluing its currencies, there are going to be consequences to that. And he uses what I call the traffic light system. He says red, yellow, green in the U.S., that's the traffic light. But he said we're going to divide U.S. trading partners into 3 categories. So green, you're a friend, you work with us, we've negotiated the tariffs, you accept the tariffs, and you accept the fact that we're going to devalue the dollar. Yellow, you're okay, you're not an enemy, but you're not our best friend, and you may suffer higher tariffs. Red, you're an adversary, clearly China and Russia. I think it's a mistake with Russia, but China and Russia would be in that category. You're going to get tariffs, if not sanctions, etc. But in addition, this is where it gets tricky. He injects national security considerations. Like, wait a second, this guy's an economic advisor, maybe a Fed governor, but what's he doing talking about national security? Sounds like Henry Kissinger. But he said, if you're in the green category, you will get the benefit of U.S. military protection.
Sure.
You'll get the nuclear umbrella and more. If you're yellow, we may work with you, and if you're red, you can expect that we'll be in an adversarial position. So the significance of that is he's putting military might and security guarantees behind his claims about the U.S. dollar and exchange rates. Now, that's only been done twice in U.S. history. One was between 1971 and 1974 when Richard Nixon closed the gold window. It suspended the ability of foreign trading partners to redeem dollars for gold. The second time this was done, where the goal was to devalue the dollar, was 1985. James Baker was Secretary of the Treasury. Ronald Reagan was president, but this Baker really took the lead on this. And using some of these indices I mentioned, the dollar was at an all-time high, and Baker said, no, it's not good enough. We have to devalue the dollar. So the dollar dropped about between 15 and 20%, depending on the cross rate at the time. So here's the third instance of the U.S. engineering a devalued dollar. This isn't the markets doing this. This is the U.S. Treasury insisting on it. So I look at the Aussie dollar, sterling, Swiss francs, euro, and say, you're all going to get stronger because the U.S. wants that. The U.S. is forcing that to happen and backing it up with some pretty nice rewards, carrots on the one hand, but a stick if not.
Jim Rickards recalls that since 2010, central banks have shifted from being net sellers to consistent buyers of gold, led by Russia, China, and others steadily accumulating reserves. China, Russia, Turkey, and India have led global central bank gold buying in recent years. China resumed reporting reserve increases in 2022 to 23, adding over 150 tons in early 2023. Russia keeps buying domestic gold while cutting U.S. treasuries. Turkey continues heavy purchases despite economic strains. And India steadily grows reserves while reducing dollar reliance. Eastern European banks like those in Poland, Hungary, and the Czech Republic have also accelerated gold accumulation. Overall, BRICS nations now account for the bulk of central bank demand, far outpacing Western buyers. In addition to this, central banks now hold 36,000 tons of gold, surpassing their treasury holdings in value for the first time since 1996, valued at approximately $4.5 trillion versus $3.5 trillion in treasuries. For the last 3 consecutive years, central banks have purchased over 1,000 metric tons of gold annually, roughly double the pace seen in the preceding decade. A World Gold Council survey shows 76% of central banks plan to increase gold holdings over the next 5 years, while nearly 75% expect to reduce exposure to U.S. dollar assets, a sign of accelerating de-dollarization. Jim believes this central bank buying creates a price floor for gold while leaving unlimited upside, making it a strong long-term play. Now let's delve into the interview.
Well, you're exactly right, Jordan, about the central bank buying, and the turning point. You can actually chart this, was 2010, but right after the global financial crisis of 2008. From 1970 to 2010, central banks and finance ministries, sovereign wealth funds were net sellers of gold every single year. Beginning in 2010, central banks collectively became net buyers of gold. Russia has more than tripled its gold reserves from about 600 metric tons to almost 3,000 metric tons. I guess it's gone up closer to 5 times. Same thing with China, from about 600 metric tons to 3,000 metric tons. But we've also seen Japan go from 600 to 900 metric tons, etc. Kazakhstan, Vietnam, Philippines, Mexico, Turkey, Iran. Iran's not transparent, but they've been buying gold, etc. So you have this fairly large group of central banks who are buying gold. Where are the sellers going? So between 1970 and 1980, the U.S. sold 1,000 tons. We went from 9,000 metric tons to about 8,100, just a little over 8,000 metric tons. But the U.S. stopped cold. We never sold any gold after 1980. And there are reasons for that. Probably don't have time to go into them. They're highly technical. But so the U.S. has stopped selling gold. We're no longer a seller. We've just stopped at 8,133 metric tons. So the sellers went away. The buyers continued. They will continue going forward. And what's interesting from a gold investor's point of view, central banks and finance ministries are actually very smart buyers. They don't chase the market up. They buy the dips. I hate to use cliches, but they buy the dips. They put in just steady orders. They're not out to buy, the whole, everything they need at once. It'll be, 20 tons a month, which Russia did. Central Bank of Russia was very transparent. By the way, just as a quick aside, Elvira Nabiullina is the head of the Central Bank of Russia. In my view, she's the only central banker in the world that actually understands her job. But she put 25% of Russia's reserves in physical gold stored in Russia between 2010 and 2022, which was the beginning of the war in Ukraine. So what did the U.S. do? Well, the U.S. and Europe froze $300 billion worth of U.S. Treasury securities that Russia had bought lawfully. They shipped oil, got dollars, bought Treasury securities, trusted the United States, which was, hindsight, turned out to be a mistake. So there are about 200 billion of Treasury security, Russian-owned Treasury securities in Euroclear. That's all been frozen. The U.S. does it all the time. We're good at freezing things. But now they're stealing it. They're actually seizing it and using it and the interest on it as collateral for loans to Ukraine so that Ukraine can buy weapons to fight Russia. So Russia's own money is being used to fight Russia via Ukraine. But why hasn't Russia crumbled? Well, the answer is they had $150 billion in gold that the U.S. can't touch, can't freeze, can't seize. And that's one of the nice things about gold. It's not digital. I can't hack it. It's just there. Unless you want to invade Russia, which is a whole different thing. And one of the ironies is when the U.S. put all these sanctions on Russia, every sanction you can think of, they've failed. But one of the reasons was they had gold, and Russia has actually made $50 billion in mark-to-market profits on their gold reserves. So on the one hand, we are stealing their Treasury securities, but by doing so, we're helping to create geopolitical risk, drive up the price of gold. And Russia has more than, at this point, more than $50 billion profit on the gold. So kind of what goes around comes around. Now, here's the thing. From a gold investor's point of view, I like this. This is what is called an asymmetric trade, meaning with a central bank buy, you have a floor. It's not a hard floor. There's no guarantee, but you have a de facto floor under the price of gold, but you have unlimited upside. So you can buy gold with some confidence that it's not going to go down a lot because the central banks will just buy it. At the same time, the sky's the limit in terms of where it might go. So it makes gold a very attractive trade. I should be clear, we are not at the frenzy stage yet. This rally has a long way to go. And the reason is it is a precious metal, exactly as you described, Jordan, but it's also an industrial input. And so the price moves on both vectors. So as a precious metal, I do expect it to go higher. There's no way that gold is going to double or triple, and silver won't, be along for the ride. So you can see $100 silver at some point, and even higher from there. But at the same time, if we're going into a recession, which I expect we are, and manufacturing is declining, and everywhere from China and the U.S. as well, Europe, all over really, then there might be less demand on the industrial side. Although it's demand for electronics is still strong. So you've got sort of two forces. It's going to go up on the precious metals vector, but maybe lag a little bit in terms of the industrial input vector. But on net, I do expect silver to go up.
Do you think central banks' move toward gold signals the beginning of a new monetary order? Could silver outperform gold in the years ahead as industrial demand recovers? If you have any comments, please share them here. In order to receive our latest updates, please subscribe and leave this educational video a review. We appreciate you coming along on this journey.
I think that the precious metals rally is saying that inflation was much higher than what the government was publishing in terms of CPI. The gold price is reflecting collapse in the purchasing power of money. And now the gold price is probably reflecting the cost of living increases between 1971 and today, rising strongly. So I wouldn't rule out that we could have gold and silver and platinum making short-term highs in the not too distant future. Gold would be a reasonable alternative.
The recent rally in precious metals like gold, silver, and platinum likely reflects much higher real inflation than official CPI figures suggest. Since the US left the gold standard in 1971, the purchasing power of the dollar has collapsed, and gold's rise is tracking the true increase in the cost of living over time. Ray Dalio says markets risk a hard attack from rising debt costs in the US and suggests holding 10 to 15% of one's portfolio in gold as protection. Moreover, Goldman Sachs warns of this scenario. The idea is that political interference could damage trust in traditional assets and the dollar, making gold more attractive. In the near term, new highs in metal prices are possible, and gold remains a strong long-term store of value. The speaker, Dr. Mark Faber, often called Dr. Doom, is a Swiss investor, economist, and market commentator. Gold's rise since the US left the gold standard in 1971 reflects the loss of money's purchasing power and higher living costs. Markets don't move in straight lines, they surge, correct, then resume upward. Over 10 years, gold would be a strong long-term choice compared to stocks or bonds. Gold is up nearly 40% this year, outperforming most assets as Fed rate cuts, a weaker dollar, central bank buying, and inflation fears drive demand. Forecasts put gold between $3,700 and $4,000 by mid-2026. Treasuries remain debated, with long bonds seen as fragile, while short bonds or cash offer optionality. Still, gold and miners are favored amid economic and policy risks. In downturns, gold is viewed as insurance. Mark Faber specifically mentions the mining stocks like Barrick and Newmont. Barrick is streamlining by selling non-core assets to focus on top gold and copper projects, though production and regulatory risks remain. Analysts view it as undervalued. Newmont has been upgraded to outperform for its turnaround, strong cash flow, and leverage to rising gold prices. Both miners are seen with significant upside, potentially doubling if gold's rally continues. As we start the video, don't forget to hit the bell icon and subscribe so you don't miss any updates. Please give us a thumbs up and leave a comment below if you enjoyed the video.
The gold price is reflecting the collapse in the purchasing power of money since the US abandoned or exited the gold windows in 1971, August 1971. When gold was at $35. Now the gold price is probably reflecting the cost of living increases between 1971 and today by rising strongly. That would be my view. But as you know, markets don't move in a linear fashion. They move up strongly, then they overshoot, then they correct for a few years, and then they resume their upward trend. So I wouldn't rule out that we could have gold and silver and platinum making short-term highs in the not too distant future. That I wouldn't rule out.
And
but equally, you know, if you ask me, Mark, you have to go to jail for 10 years. It's always a possibility. And then you have to invest your assets in one asset class and only one asset class. You cannot diversify. So you can choose properties, or you can choose stocks, or you can choose bonds, or you can choose gold. And you have to choose this and leave it until 10 years hence, 10 years later, when you get out of jail and want to collect your assets. In that case, what would you invest in? In stocks, bonds? I mean, I think gold would be a reasonable alternative. I mean, I've never been terribly keen about mining companies, but starting, say, about 9 months ago, I wrote that for the first time, I was rather positive about mining companies because they were incredibly low compared to the price of gold, which had gone up substantially. The mining stocks hadn't gone up, but this year the mining stocks rose substantially. And I still like mining companies. I want to explain to you why I like mining companies. I think if you look at Barrick or Newmont Mining, the stocks have gone up, but they're not meaningfully up compared to previous highs. So I'd say this is a sector in the market. You asked me about value in the market, what it was desirable. I think mining stocks are very desirable. I think Barrick and Newmont, they can easily go up another 100%. I think US treasuries is an alternative, not ideal, but say relatively favorable. And then cash is not a desirable investment, but it may be better than other assets in a downturn. You understand? You're not going to make money.
And it gives you optionality. You have optionality in case you have opportunity.
Yes. But my sense is that if everything goes down, I tell you, it will be very difficult for you not to lose money. But let's say everything goes down 50%. Like in the Depression, it went down everything 80% or so. In that case, you're the king if your portfolio only drops 20%.
Mm-hmm.
You understand? The market assets go down 80%. And you are among the fortunate ones where the asset value drops 20%.
Mark Faber points out that the dollar stayed strong until late 2014, mainly due to capital inflows, not fundamentals. Trump's policies weakened global confidence in the U.S. Meanwhile, the U.S. is in recession despite official denials. Recent analysis highlights that inflation remains sticky, with real interest rates often negative and underlying price pressures not fully reflected in official CPI data. At the same time, a weakening dollar, growing doubts about central bank independence, and geopolitical risks are driving investors toward precious metals. Gold, silver, and platinum are increasingly seen not just as profit opportunities but as safe havens and long-term stores of value. Now, let's just reflect on the interview.
The dollar has been exceptionally strong until November 2024. And it has weakened since then. And if you say, or if you argue that it was in the cards that the dollar would decline, then I agree. The dollar has been strong, but not based on fundamentals. It's been based on capital flows. In other words, the world moved capital into US assets. And so the currency remains strong. But I think Trump has done a lot to destroy, to destroy the confidence people had in America. The bond market in the US should rally because we're heading into a recession. I think we're already in a recession, But of course, Trump and his henchmen will argue, no, we are doing extremely well. And the economy is exceeding expectations, and so forth and so on. But the reality is that if you look at the living standards of ordinary people, they're not doing well. No way. And the wealthy people, including myself and so forth, we benefited from asset appreciation and did very well in the last 30, 40 years. Ordinary people that have no assets, they've been hurt because the cost of living is going up much more than their salaries. So ordinary people get squeezed. And ordinary people is 70% of the US economy. There are instances where when they cut rates, the market goes up, and there are instances where it goes down, depending on the expectations that preceded the interest rate cut. But in the present situation, a 25 basis point cut wouldn't do anything. That is expected. 50 basis points, I think the bond market would react favorably, but not hugely. I mean, my view is the bond market will go and sell and trade until the yield on the 10 years is between 3 and 3.5%. Because I think the economy is much, much weaker than what the Trump team pretends it to be. Most people aren't doing well economically. Now, is Jeff Bezos doing well economically? Yes. There, say, 500 people in the US that do exceedingly well. Then another 10,000 people that do relatively well. And then there are zillions that don't do well.
Do you agree with Dr. Faber that gold is the most reliable long-term store of value compared to stocks or bonds? Could mining stocks like Barrick and Newmont really double in value if gold continues its upward trend? If you enjoy the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us, and wait for the next updates.
The purchasing power of the dollar has is fallen 99%. Those are the numbers you're saying. 99%. The dollar went totally fiat. Now, the dollar started declining before then. I mean, bear in mind that until 1934, you had $20.67 to the ounce. And that was from, 1856 or something. And it was... it was de facto, but then it became de jure with the Gold Act in 1900. And I reckon in 2026, you're going to see a combination of a collapsing dollar, higher tariffs, pushing up prices, if you like. That's so much like Germany between 1922 and 1923.
Although the dollar's decline began earlier, it has already lost about 99% of its purchasing power since it was separated from gold. Deutsche Bank has explicitly warned of a crisis of confidence in the US dollar, suggesting that shifts in global capital flows might overwhelm usual currency fundamentals, causing erratic moves. JP Morgan says the dollar's long bull run is ending, with an expected 10 to 20% medium-term decline against the euro and yen. They see this not as a collapse but as a gradual reset. By 2026, increased tariffs and a failing dollar might cause prices to rise, a scenario similar to Germany's inflation crisis in 1922 to 1923. The dollar has lost around 99% of its value, albeit the slide started earlier. The 1900 Gold Act established that $20.67 would purchase 1 ounce of gold until 1934. Now, in mid-2025, JP Morgan warns that U.S. tariffs, trade policy, and slowing growth could lead to stagflation. They lowered their U.S. GDP growth forecast for 2025 to 1.3%, from 2%, owing to tariff impacts. They also expect foreign demand for treasuries to decline, which weakens one pillar of dollar strength. The International Monetary Fund (IMF) has also flagged that recent U.S. tariffs could add inflationary pressures and warned of weakening domestic demand and slowing job growth. The Roaring Twenties and the 1929 crisis were both exacerbated by Hoover's tariffs and the Fed's credit expansion under Benjamin Strong. Now, the risk is much higher and might destroy the currency due to Trump's tariffs at the height of a huge debt bubble. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
Well, basically, what you've said it all. I mean, the purchasing power of the dollar has fallen 99%. Those are the numbers you're saying. 99% since the dollar went totally fiat. Now, the dollar started declining before then. I mean, bear in mind that until 1934, you had $20.67 to the ounce, and that was from, 1856 or something. And it was, it was de facto, but then it became de jure with the Gold Act in 1900. Basically, when the Fed came along, they screwed everything up because under Benjamin Strong, they expanded credit. I mean, Benjamin Strong was a great believer in stimulating the economy with extra credit. And that led to the Roaring Twenties, which led to the collapse between 1929 and 1932, enhanced, I may say, by not President Trump, President Hoover's tariffs at that time, which was the Smoot-Hawley Tariff Act of 1930.
Yep.
And President Trump is doing exactly the same at the top of the debt-cum-credit bubble, which makes 1929 look like a pimple. I mean, this is the big one. It really is. And it'll destroy the currency. I think it's so important. We've got to understand this, and we've got to be prepared for it. Yeah, I mean, basically, no. We used to have a phrase, which I don't hear nowadays, about kicking a can down the road. People, I think, sort of think, whoops, I don't think it's, they start talking about a reset and, all this sort of rubbish. I mean, the fact of the matter is that the Fed has got no control over the situation. And it can't have control over the situation because the situation is politically driven. And until you persuade an electorate, to give up all their welfare this and welfare that, and, all the pressure groups to, that, look, you're out of here, forget it. We're actually going to deal with this one seriously. Until that happens, no. I mean, there is absolutely no solution, Craig. And, I've always said it's crisis first, solution second. I mean, once you have the crisis, then you can start talking about a solution. But is that really going to work? Well, I'd like to think so. But the fact of the matter is that when you get those extreme economic and monetary conditions, like, the credit collapsing in terms of its value, all bets are off. I mean, this is what they found in Germany, because what happened in 1920 to 23 led to Hitler, led to the Second World War.
Right.
I mean, Hayek actually put this very, very well in his Road to Serfdom. He sort of had a bit where everybody starts saying, we need a strong leader, to get us out of this mess, because they'd had enough of the weak politicians who screwed it up. We need a strong leader. And what did they get? They got Hitler.
Germany experienced 3 stages following World War I. The first, from 1918 to 1920, saw the mark lose roughly 80% of its value, akin to the inflation that followed the COVID-19 pandemic. The second, from 1920 to 1921, saw a brief improvement as the mark strengthened, business resumed, and optimism returned, and the third, from late 1921 to 1923, concerning parallels can be seen in the U.S. today. Officials are publicly pushing the dollar lower, markets have soared, and bond yields are still high. Only short-term T-bills are in demand, as foreign investors are shunning long-term treasuries. The dollar may plummet if bond yields increase while the Fed lowers interest rates. When tariffs are added, we may witness a crumbling dollar and skyrocketing prices by 2026, akin to Germany's hyperinflation. Since exporters benefited, politicians and business groups at the time even favored a weak mark. Similar to this, current policies run the risk of devaluing the dollar's purchasing power even while they may benefit certain groups. Let's dive into the interview.
Yeah, we're not quite there yet. I mean, you mentioning the, Adam Ferguson's book, When Money Dies, and all the rest of it, actually hits the nail on the head. Because I put out a note, I think it was a few days ago, which looked very, very carefully at what happened in Germany between 1918, which was the end of the First World War, and 1923. And there were three phases. The first one was between 1918 and 1920, when the purchasing power of the Reichsmark fell about 80%, something like that. So, this was a nasty situation. Now, this is actually quite like what happened following the COVID shutdowns.
Right.
And then we had this inflation, which meant that the purchasing power of the dollar actually fell. Not as much as 80%, admittedly, but it fell quite sharply. And then what happened in Germany from around about February 1920 to December 1921 was suddenly things improved. And the Reichsmark actually went up against the dollar, which, remember, was on a gold standard, and a proper gold standard. You could exchange your dollars for gold at 20.67 to the ounce. So the Reichsmark was strong. Businesses were recovering, if you like, from the shock, the post-war shock. There was a certain amount of tourism going on. I mean, things were really humming. The stock market tripled. Everybody thought, this is absolutely wonderful. We've got over this, etc., etc. But then there was a crash. I think the stock market lost something like 25% in the December of 2021.
1921.
Sorry, between 1921, end of 21, in other words, through 22 and 23, what happened was that the purchasing power of the Reichsmark began to collapse. And the collapse was total. Now, so far, we've had the post-COVID thing, which led to inflation, da-di-da-di-da. And now, guess what? Perhaps the long bond yield has not really declined. It's still held between 4.5% and 5%, and looks, if it goes through 5%, then we will be bricking it. It really will be very serious. But meanwhile, of course, the S&P went up from something like 4,200 in 1922 to where we are now, which is 6,500. This actually looks very, very much like that period in Germany between 1920 and 1921. So what follows? Well,
right. That's the bad news.
This is where we are. So how is it going to happen? That's the question. Well, I can see a number of things. We just had Stephen Mirren appointed to the FOMC. No, he's not quite there, but it's just a question of signing on the dotted line. He will be in the FOMC. He was the Mar-a-Lago guy who wants the dollar down and reckons that he can get everybody to agree to it. Well, good luck to that. They are going to destroy the dollar.
Yeah.
The foreigners so far, and large institutions, for some reason, are asleep at the wheel. They don't understand what's happening. There is a deliberate policy to drive the dollar lower. And if you look at the chart of the trade weighted, it is awful. It's about to fall from where it is, which is about 197.5, down to 90, and I doubt it'll stop there. So what's this mean? This means that the purchasing power of the dollar is declining.
Mm-hmm.
Now, on top of that, what do the foreigners do? Well, I mean, everybody, including the large institutions, stand back and they don't buy treasury bonds. I mean, certainly with anything mature, in terms of length of maturity, they're not going to touch it. The only thing that will sell is near cash, which is actually what T-bills are. It's almost like cash, printing cash. So that's what's going to happen. Now, you will get a rising level of bond yields just at the moment when the Fed is trying to reduce interest rates. Well, that's going to do. They're going to have to reverse that. Or the dollar tanks. And if the dollar tanks, what does that do to its purchasing power? It begins to collapse. And then, on top of that, we've got tariffs. Now, I know everybody's running around saying, well, tariffs haven't had any effect. But it does take time for this to work through. And I reckon in 2026, you're going to see a combination of a collapsing dollar, higher tariffs pushing up prices, if you like. And, I mean, that's so much like Germany between 1922 and 1923. So the next question is, I mean, we all reckoned that the Germans were muppets and stupid and all the rest of it at that time. But actually, if you read the history, you see, well, it was politics. It was politics because it lowered their manufacturing costs. You had the inflation king, Hugo Stinnes. You had, and this is a familiar name even today, Fritz Thyssen, steel magnate, etc. I mean, it was wonderful for them. They were making huge money because their costs were based in Reichsmarks, and they were selling it into global markets and getting gold-backed dollars for it.
The warning signs are obvious, and preparation is crucial, regardless of whether the dollar experiences a similar fate. Will authorities intervene before it's too late? Or do you believe the United States is on the verge of a disaster akin to Germany's collapse in the 1920s? Should the dollar really start to depreciate by 2026, how should investors position themselves? If you enjoyed the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you.